What is going on, value investors? Happy Fundamental Fridays. I had to get started a little early today because there's just so much to talk about. Happy Friday to you. I hope your week was a beautiful one. I hope you guys had a productive week. We have a couple things to talk about as far as big picture stuff, and then we'll hone in on some of the key players that are driving the DJIA and the stock market as a whole. We'll do some fundamental analysis on two or three companies depending on how much time we have. I'm going to be checking the chat too to see if there's any requests. If you guys do have any requests, please be so kind as to put them in the chat, and I will be monitoring the chat periodically. But let's get started with big picture stuff. What happened in America since the last time I saw you guys, which was last Friday. It feels like these Fridays are just whipping by, guys. It's crazy. If there was a way to slow down time, I'd press that button right now. Kind of like the Diet Coke button that Donald Trump had, which was just removed today by Biden. So I'd press that button, but let's push forward. We had a successful transition of power as far as Donald Trump leaving and then Biden coming in, which is excellent. Not a political comment at all, but there's so much to say that I think the country is at peace knowing that our democracy is still pushing forward. A lot of the I feel like a lot of the tension has been lifted off of a lot of American shoulders, which is excellent. So that's going great. I'm taking a look at Yahoo right now because I can rely on Yahoo to let me know if the end of the world is coming. I've relied on Yahoo News to tell me what's up for the last 10 plus years now, so I always like to start off on this page. It looks like we're having a couple executive orders getting pushed forward by Biden. Looks like he's worker focused. Not a surprise. He's a part of the Democratic Party, but he's supporting workers now more. Let's see what type of impact this will have on the economy as we push forward. I know last Friday, one of my good friends, Phil Boy, came on the live stream and talked about how the presidency, the Democratic presidency, might affect stocks as a whole as far as valuation and performance. And even though taxes will be generally higher, with every Democratic or blue presidency, blue office, taxes do increase a bit. I think that there's a trade-off because the masses, a large majority of the economic participants in our society are contented. And as we all know, when folks are contented, they spend more money. So we'll see how this game plays out. Let me take a look at the live stream and check the chat to see if we are looking excellent. And we're looking healthy and good to go. If you guys do have any commentary, please be so kind as to put it in the chat. I'll be monitoring that, no problem. Phil Boy, what is going on, my friend? I hope you're doing excellent. I hope you had a great last 7 days since the last time I saw you. We are just pushing forward. We did a review of just general America. We'll dive in a little deeper now. We'll look at the DJIA, and the DJIA looks like it closed in the green, but not by much. And as a matter of fact, when you look at the news, you scroll down a bit. If you just type it in on Google, you'll see that the Dow, the S&P 500, all these the big boys were lowered by Intel. And Intel is actually the company that we're going to be launching a fundamental analysis on today. It just so happened, coincidentally, as I was looking for videos to analyze tonight, I had Intel listed as runner-up. So I checked the analysis that I had, and I only had fiscal year 2019. I didn't have fiscal year 20. So I said, it's a long shot, but let's see if Intel published their earnings for fiscal year 2020, and in fact they did, which is excellent. I was super happy to see that. Looks like they posted it a little early because CEOs are switching. As of February 15th, if I'm not mistaken, Bob Swan is out, and who do we have? Pat Gelsinger. He's coming back in. He's a longtime 30-year guy from Intel who rose the ranks, and he's now CEO of Intel. And his new focus is microchips. So long gone are the days where Intel is a player in platforms and internet and the Internet of Things. You can tell if you look at their 10K and you look at their statements, they're kind of not focused. They're very broad-minded. They're very soft in their words. I was actually surprised to see that typically they're an undervalued company, which is nice, and we'll talk about how undervalued they are in a moment. But if you compare Intel, which is traditionally has been a microprocessing semiconductor company, you compare that to TSMC, which is a Taiwanese-based semiconductor company that really takes care of all of Apple's products. If you look at their mission statement at TSMC is very dry, clear cut. They're like, their mission statement is we produce microprocessors, point blank, period, full stop. Intel, on the other hand, you'll see in a moment, is a little different. But maybe with this new CEO, we'll see them start to focus. They will hone in on what got them to where they are today. So let's see. So DJA fell or closed in the green, but not by much. What about cryptocurrencies? I always like to take a look at cryptocurrencies. I'm making this a new thing of the live stream, just keeping our focus broad in the beginning, and then right around 7, I'll dive deep. But as it stands now, if you guys remember last Friday, cryptocurrency market as a whole, the market capitalization was at $1 trillion. It's down by 50 billion, just about to 954 billion and some change, which is neither here nor there. I mean, that's not really that large of a movement when you consider the immensity of the market in and of itself. And it looks like it's pretty split. I mean, what's really curious, what I'm very curious to see is when will Bitcoin lose dominance, right? And I think you're starting to see this now with some of the second generation and third generation coins. So Bitcoin is a first generation coin in the sense that it's very basic. It's based off proof of work rather than proof of stake or some other ledger mining system. But you see Ethereum is a second generation. Tether is nonsense, and I'm sure that'll be kicked out in a moment. There's a lot of controversy around Tether. Polkadot looks pretty cool. I haven't looked too much into them. XRP is in a lot of trouble with the SEC. Cardano is a proof of stake coin. It's a third generation coin, and it's actually launched by Charles Hoskinson, who was associated with Ethereum to some extent. I really like Cardano. I'm just wrapping up the top 10 here. Litecoin is a second generation, if I'm not mistaken, proof of work coin that it's mined by large amounts of electricity. These GPUs have to basically solve large mathematical problems, right, based off primes and all this difficult stuff. And there's a lot of electricity and a lot of cooling that has to be done when you're looking to mine a world computer like this blockchain technology. Chainlink, Bitcoin Cash, and Binance Coin, those I don't care so much about, but I'm very curious to see when we'll see the second generation, third generation coins kind of take precedence over the first generation. I know 100% that within the next 50 years, if it's not the millennial generation, it'll be Gen X or Gen Z that will take a look at all the electricity consumption of these proof of work coins and throw up the red flag and say, hey, our politicians have to do something about this. Already in Western New York, here where I live, if you get caught with a Bitcoin mine, right, and they'll find you if the electricity company sees a large amount of electricity being used. If you get caught with something like that, you'll get all that stuff seized by the government, at least on the municipal level. I know that's for sure, because they don't want you drawing that much power from their network. So let's talk about Intel. And let me check the chat too to see how we're doing. Already 1 a.m. in Vienna. Wow, incredible. Hey, NYCFC for life. God bless. God bless. It's always a pleasure to see my folks. It's so nice to see you guys. Thank you for stopping by. Let me just drop something in the chat. Nice. Okay, let's push forward, guys. So we will move on to, and thank you so much for spending some time with me on this Friday. It's 7 p.m. at least here in New York. So I guess it's 1 a.m. where you're at, Phil Boy. I hope you had a good day, and I hope you're having fun. So Intel, so I just want to preface this Intel. We're going to just look at the SEC, the 10K document briefly because there's not really too much value to be had. But I just want you guys to know that this was doctored and written by the old CEO, Bob Swan. So Bob Swan is the guy who's putting all these soft, lovey-dovey words on this document, right? Look at our purpose. Our purpose is to create world-changing technology that enriches the lives of every person on Earth. Our vision is to be the trusted performance leader that unleashes the potential of data. Now, I understand that it's very difficult to be super specific when you have a company as broad as Intel, but come on, let's scrutinize these folks a bit. Just look at TSMC's mission or vision. And yes, I know the difference between the two, but TSMC has a more refined, more specific mission and vision. So that's one thing. There's two other things I want to take a look at on this document. The second thing is going to be found on page 86. Excuse me. Okay, so on page 86, these are the notes to the financial statements. Intel says that we derive a substantial majority of our revenue from platform products, which are our principal products and considered as one class of product. So platform products are like Internet of Things, just different technologies, basically other than microprocessors and semiconductor units, which is strange because that's what Intel got so famous with. That's what they built their huge corporation on, which is it was producing microchips. They got away from that for some reason. Bob Swan let the company get away from that, and I guess the board directors, right, knowing the new guy's approach, Pat Gelsinger's approach is let's go back to what worked. 9% dip today for Intel with the news of the switch of CEOs and the new focus on microprocessors. Now, to be honest, I don't know how this is going to work out for them. If I'm being humbly very honest, um, a reversion, right? So narrowing down their focus to microprocessors might hurt them in the long run because, platform companies and Internet of Things companies and just all the stuff that Intel was focusing on. I'm not saying I'm an expert on what they do. I'm not saying that, but I'm just saying that refocusing on microprocessing chips might limit their business a bit, and it might decrease their revenues. Henceforth, it will decrease their net profits. And markets are slow; they'll lag, but they will also converge on a decrease of net profits, right? Or at least the theory says they should. So we'll see what happens. On page 88, let's push to page 88. One last thing on this document that I want to point out, qualitatively speaking, before we dive into some hard numbers. In 2020, our three largest customers accounted for 39% of our net revenue. It was 41% in 2019, and the same basically in 2018, with Dell being the largest, Lenovo being second, and HP being third. Now, just based off principles of economics, it's not so rare to find monopolies or pseudo monopolies like this that like Dell, HP, and it's what I'm talking about, that will buy from microprocessing companies like Intel. Same thing happens with TSMC. So I'm not necessarily criticizing that, but I did want to point that out that with when you limit your customer base to it's almost half. The three folks make up half of their revenue. That's kind of dangerous. And that was a huge red flag for me that at least that I saw that I wanted to bring to your guys' attention before we dive into the formal analysis. Let me just check into the live stream here. Intel is super interesting how with the new head of company. Yeah, that's for sure, Phil Boy. I'm going to be very curious to see how Mr. Gelsinger plays out. But we will push forward. Let's see. We'll take a look at this. We'll take a look at some ratios now. So Ready Ratios doesn't have the comparison for fiscal year 2020, but regardless, there is selection bias with any year that you choose to look to conduct a ratio analysis, unless you're using medians, which I do in my Excel analysis that I'll show you guys in a second. But let's just take a look at what kind of numbers they're running, at least from a liquidity perspective and a profitability perspective for fiscal year 2019. For liquidity ratios, I want to specifically look at current ratio. And if you don't know what current ratio is, it's basically just current assets divided by current liabilities. So they have 1.40 as compared to industry standard of 2.36. And what does that mean? So for every dollar in current liabilities, Intel has $1.40 in current assets. This is a liquidity test because, and this has happened in the past, if all your debtors say, hey, I need you to pay me right now, they call the notes, then they would have $1.40 in cash and cash equivalents to pay their debtors, which is great. You typically want to see this number be anywhere north of 1. But their industry, the competitors, are beating them out by basically $1. So not necessarily too important. As long as it's above 1, then we're fine. But it looks like the industry as a whole is beating them out. And who are their industry competitors? We're talking Broadcom, Micron Technology, Applied Materials, Texas Instruments. Now, the next thing that I want to take a look at is not a liquidity ratio, but a profitability ratio. And I want to look at the profit margin. Look at this huge profit margin in 2019. Now, 2019 was a stellar year for almost any company. I mean, if you were doing business in 2019 in America, you were making bank. I'm shocked to see that their competitors only spit out 0.3 cents off of every dollar earned from customers. But Intel was able to keep 29.2 cents off of every dollar provided by customers, which is insane. If you take a look at all the companies of all the industries in the entire, Americas, and there are some Chinese and European companies in this, I believe, as well, they kept 3 cents. So 3 cents off of every dollar provided by customers was retained by all companies. That's massive. Let's push on to the actual analysis. And we will start with revenues, giving you guys a little sneak peek into the intrinsic value. It's not a shock. Intel is definitely has been a company of curiosity for me, only because their intrinsic value is so close to their share price, especially now with the drop, right? The 9% drop that they experienced today in the market. Now more than ever, this might be an opportunity to buy. Now, I don't have any proper licensure to make a claim or to offer advice, but it's just for educational purposes. And if I were you, I would conduct a more serious analysis and really start to look at how much money could I potentially devote to Intel. We'll start with the revenues. So revenues, just looking from the curve from 2010 through 2020, and I'm so happy they published their results today. They just published their 10K results for fiscal year 2020 today. I mean, how lucky is that? What a great fundamental Friday we're having, huh? So revenues in millions, steady. It's exactly what you want to see. You don't want to see them take too much price. Because if you see a stark increase in revenues, and that means that they might be charging their customers too much, losing out on opportunities for market share to increase their market share and take it away from some of their competitors. But Intel is looking like they're doing a great job of keeping their products nicely priced. Pricing strategy is incredibly difficult to maintain, and it looks like they're doing a good job of that. So median revenues in the last 10 years are $55,870 million. Now, why did we take a look at the median? If you're new to the channel, first, welcome to the channel. I'll answer the question for you guys now. For the new folks, if Intel has to weather a storm, right? Typically, in history, we've seen that companies will revert to some statistical center, and I choose median only because it's absolved from biases that befall averages, right? So averages are subject to large increases or decreases on the basis of outliers, but with outliers don't really affect median all that much. So if we were to see Intel have to weather some serious storm, they would most likely revert to this revenue number. Now, what I like to do is I like to take the median 10-year revenue number, and then I like to take, in this case, it's fiscal year 2020. I like to take the most recent published fiscal year, and I like to add up all their expenses. So we're talking cost of goods sold, operational expenses, income taxes, or rather just corporate taxes, I should say. Add up all the expenses, right? And then I take this top figure, the median revenue in millions, and then I subtract all those expenses here, and then I get a number down here as a result. If that number is positive, then that means that the company's in good shape over the last 10 years. If it's negative, then we have some problems. As a matter of fact, I think we might be able to do that right now. Why talk about it? Let's just do it. Let me check in to the chat. Caesar, great job, Brenden. Thank you, Caesar, and welcome to the live stream, my friend. I'm happy to have you. Let's push forward and let's just do this quick analysis. Let's see if we can find it on the financial statements here. So we'll take a look at. Let's see where let's start from the very top, and let's scroll down to. Here it is. Consolidated financial statements on page 74. Nice. Okay, so let me get my TI-84 Plus, and bear with me. Don't leave the live stream. This is just the pains that we have to go through of doing a proper fundamental analysis. So cost of sales are $34,255 million plus operating expenses totaling $19,934 million. Plus, let's see, income before taxes. What about the provision for taxes? There we go. So 4179. Did I miss anything? Nope, didn't miss anything. So it looks like that their total expenses are $58,368 million. So let's take a look. Let's add that in here. So minus, let's do equals this minus 58,368. And look at that. So we have, using our test, right? I don't like to put this on. I use these files for the actual YouTube videos that I create and edit, with a bit more, a bit more editing, right? I like to do the live streams regardless, because I want to have that personal connection with you guys. So that's why I don't have a formal system for this calculation. But I thought it was important to show you, especially with Intel, that with this type of test, if they were to weather some sort of storm and revert back to a statistical center, this median of 55 billion and some change, using the operating expenses, the income taxes, etc., of their most recent fiscal year, which probably wouldn't change if this storm were to occur in 2021 or 2022, right? Keep that in mind. That's what gets companies in trouble. Then it looks like they would be in the losses, not by much, by about $2 billion and some change. So that's not bad. I've seen companies with way worse numbers than that. Let's push towards net profits. So for Intel, who just published their 10K statement today, how lucky are we? What are their net profits looking like? So the median net profit, $11,464,000,000, right? And some change. There's that line right there. Net profits look kind of wonky. You know, you expect to see a curve similar to this revenue curve here, but for net profits, this beckons some explanation. If I were to invest in Intel, I would definitely look at why they have such a large increase here in net profits. You know, really, if I were on the board of directors, I would say, why couldn't we have done this in 2017 or 2016? What happened in 2018 that we published such high net profits? Did we miss out on an opportunity to increase market share? I see a lot of folks sometimes when I'm going back and forth with people, they'll tell me, well, why do you think that a large jump in net profits are bad? You know, jumps in net profits are great. Not necessarily. You have to be a bit more skeptical. And, you know, I didn't do the full launching investigation as to why they posted such high net profits in 2018. And look at that, they're kind of stagnating out here. Maybe the reason why they got rid of Bob Swan in the first place and they're putting in this new guy, Pat. But I would argue that if you look at their cash balance, right, the only reason, so think about how do net profits increase, right? Net profits increase by either increasing your revenues and your profit margin stays the same, but the actual raw net profit increases along with the increase in revenue, or expenses decrease. I personally think that with all the trouble that Intel's been having in the last couple of years, I don't think their revenues increased. I don't really see evidence of a dramatic increase in revenues. What we do see is a decrease in their cash and cash equivalent account. Look at this. They decided in 2015, they saw their 2015 cash balance at an all-time high. I already know how this conversation went in the boardroom. They said, listen, we have a crap load of liabilities and we're paying a lot in interest expense. We need to cut that down. This is what I humbly believe is what happened, right? So 2016, they were kind of conservative, but not really. They spent a crap load of money paying down liabilities, right? So remember, they didn't increase their revenues, but they decreased their expenses because liabilities yield interest expenses. And when you get rid of that, then your net profit increases. So in 2016, they said, well, we need to be more aggressive. So they spent even more money probably paying down debt. 2017, 2018, cash balance completely bottomed out. 2019 and 2020, they kind of stopped that behavior, but it only paid off so much looking at their net profits. It only paid off so much because now in 2019 and 2020, it stagnated. And I think that the old CEO, Bob Swan, probably got in a lot of trouble because he thought that this was really going to fix Intel's problems. And I think that it's a matter of focus. I really do. I think it's a matter of focus. And I think that Pat has something going for him when he says that they need to look back at microprocessors and being a microprocessing semiconductor company again. Not an Internet of Things company, not a platform company. Let other guys take care of that stuff. We need to focus on what we're doing right. There's even been some articles about how they're trying to earn back Apple's business. Apple just launched the M1. They got rid of Intel. They've been using Intel for a long time now, and now they're doing their own in-house thing. So I mean, imagine how butthurt Intel must feel knowing that they got dumped by one of their, one of the biggest companies on earth. I mean, I'd be crying if I were Bob. Anyways, pushing forward, balance sheet. Total assets, 153 billion and some change. Stockholders' equity, right? So the owner's interest in those assets represent an amount of $81,038,000,000 for a percent of total assets owned by stockholders' equity in the amount of 53%. Book value per share is just a sweetheart ratio that we always like to take a look at because this is basically taking their real net worth, not their market capitalization, their book value, divide that by total shares outstanding, which was 4,000 and some change, or excuse me, 4 billion and some change for fiscal year 2020. So basically just taking this number, 81 billion, divided that by 4 billion, and you get $19.95 per share that you would earn for every share that you purchase from Intel. Now, if I told you that, right, if I told you that I was selling shares in my company for which represented $19.95 in value in the form of assets. I mean, why would anyone want to pay more than $19.95? Why the hell would you do that? I mean, and don't get me started on the goodwill stuff, because goodwill, I don't believe in goodwill. That's something fanciful that doesn't exist. You know, our investments are tactile. We need to be able to feel them, touch them, and I wouldn't pay much more than $19.95 or something like that, especially with such an ever-changing world that we live in. Cash flow statements for Intel. So cash flows from operations for Intel represent an amount of $35,384,000,000, with total assets amounting $153,091,000,000. I like to look at the cash flows from operations to assets ratio, because this tells me how large their cash inflows are from operations with respect to the total amount of assets that they own. This would be akin to, if you're doing business with me, you want to know how strong my income is. So if I told you that I have $25,000 in total assets, but I'm earning $1.25 million per year, well, I mean, by that standard, you'd say, well, my income is very strong. But if I told you I was earning $1.25 million year over year, and I have total assets amounting $1.3 trillion, well, you'd say, Brenden, why the hell aren't you making more money? You have all this assets. What are they doing? Just sitting in your backyard? You know, you got to put them somewhere productive. That's why we do this test. So we want to see typically anywhere north of 5%, completely subjective figure, but 5% I've seen tests pretty well and helps differentiate or distinguish between different companies. It's just another hurdle that we got to put companies through, value investors, to make sure that that if we are going to invest in Intel, we're doing the right thing. 23% is solid. Quality of earnings ratio is an accounting fraud ratio that will check for just that. So we want to check to see if the net income that Intel is reporting for their most recent fiscal year is inflated, right? That's one of the most common ways that CEOs and management will lie, cheat, steal. They'll inflate the net income number because a lot of investors, they know, will look at that and they'll make their investment decisions off of that figure. So quality of earnings ratio is just a simple proportion, right? All it does is it takes the cash flows from operations in the numerator, and then it puts the net profits in the denominator. Now, you want to see typically a number north of 1. So 1 or better is great, right? Because that means that cash flows from operations are massive and net income is conservatively reported. If you see something less than 1, like 0.5, then that means that cash flows from operations, you know, they're getting a little bit of cash, but they're reporting all this net income. What's going on here? Let it be known that business theory states that net income and cash flows from operations must converge over the long term. They have to converge over the long term. It's kind of more technical. Even I don't have a full understanding of it. I just know that that's what's got to happen. We're talking over years. So as long as this is good, this is just for one fiscal year, for fiscal year 2020, we're looking solid with Intel. Now, what is Intel's intrinsic value? As we come to the 21st minute of the 7th hour in the evening, at least here in New York, what are we looking at? 421 to 56.45. Now, what is that based off of? If you're new, welcome to the channel, I'll tell you. So the low end represents Intel's cash and cash equivalents. So for every share issued and outstanding, Intel has $4.21 in cash and cash equivalents. How about the high end? The high end is a representation of the company's earnings. Why would you buy Intel for anything other than, you know, if you're trying to come up with a range, anything other than their earnings? You know, you're buying a company because you want that company to spit out money at you again and again. You know, you need a company to be a going concern, as they say. It needs to live in perpetuity, spitting out money for you and your stockholders. This is why we have this on the high end. So this keep in mind, though, that this has a multiplier of 20 in it. So this is basically just Intel's median earnings times 20. Why 20? Well, Benjamin Graham says that this is a reasonable multiplier that represents the maximum time horizon that we should be willing to wait to earn back our investment in the form of representative earnings. Using the owner-centric perspective, if you were to purchase the company, Intel, in full, then that means that you would be getting all those earnings that they make, right? So you get your revenues, you subtract your expenses, and then you have earnings. Then it's your decision as the holder of those retained earnings, assuming you had 100% control and you were the only person who owned Intel, then you'd have to make a decision as to what you do with those retained earnings. Do you keep it in the company? Do you spit it out in the form of dividends to yourself and payments to others who have helped invest in Intel? What do you do with that cash? So you don't want to wait for more than 20 years to get back your earnings, because you don't know what's going to happen in 20 years. And even 20 years is a bit too much, especially with a technology company. Because remember, changes in the technology industry are not iterative, they are explosive. So, what are they trading at today? Let us take a look. Intel closed, let me just refresh. So Intel closed January 22nd, 7:30. We just got this update at 7:13 p.m., but of course they closed at 4:30, I believe, on the Nasdaq. 56.66, so a couple cents higher than this 56.45, but still intriguing. Still intriguing. I'm not going to knock them for those couple cents, even though that translates into a lot of money when you work it out on a company perspective. Using the owner centric perspective. Um, it's totally your call, guys. Totally your call. I find it very interesting that they're trading at this figure, with new guy Pat Gelsinger coming in, and even I want to show you guys this as a last look before we move forward. Let me see if I can find the article. Here it is. So a lot of the old guys, a lot of the old engineering folks and some bigwigs, seniors, are coming back to work for him because they love him this much. Look at this guy, Glenn Hinton, who's an Intel senior fellow. He retired for 3 years, but he decided to go back to work at Intel when he found out that Pat Gelsinger was coming back as CEO. So that says a lot about Pat. It says a lot about the talent that they have at Intel. I don't know what happened that Bob kind of is almost like brain drain. Bob might have lost a couple of these high performing folks. They say that the best people in your company are the ones to leave first when there's a problem. So maybe with this, Intel is going to be turning a new leaf, and maybe as value investors, this might be the time to buy. So, not financial advice, but just saying. Let's check the live stream and see what we got going on. NYCFC says it's funny because I was just thinking about Goodwill yesterday. I was looking at the balance sheet of SPI and they had Goodwill listed as an asset. I guess they want to get bought out or something. Yeah, I find Goodwill funny. Even Warren Buffett will talk about Goodwill in the sense that it's definitely a strange thing. People try to pass it off as something that it's I don't know. I don't fully believe in Goodwill as much as other people do. Reputation is a big thing for sure, but when it comes to companies, I would stop. I'm very hesitant to pay any more than what the assets are valued at the end of the day. So let's push forward to the next analysis. Let me exit out of this Intel one. Don't save. And then let's do Cisco. Let's take a look at Cisco and see what we got going on for Cisco. So for starters, I want to just type in Cisco here. Cisco Systems, and then we will bring up their, so this is the Edgar site, if you're unfamiliar with it. This is where you can get all their 10Ks and all the juicy stuff on the companies, including litigation and all the nasty bits that they don't want you to see. Let's see, where is that? Here it is, 10K. Hopefully this is for fiscal year. Well, they don't have fiscal year 2020, but they have fiscal year 2019. So let's just push that up and see what kind of language. When I look at 10Ks, I'm just looking for the language that they use. I want to see what the zeitgeist is in management. So item 1, business. Cisco designs and sells a broad range of technologies that have been empowering the internet since 1984. Excellent. What else? Let's push forward. Let's see some Cisco news. Okay, we are back. We are back. I appreciate you guys. Nice. Okay, we're back. I don't know why that happens on OBS, but we were able to adjust it appropriately. Thank you guys for letting me know. So let's see. So the audio went out from the stream, and it looks like it's been off since we were looking at the ratios. Okay, well that's fine. We'll do a brief recap because I was just about to get to the intrinsic value. Let me just make sure that OBS is on point. Okay, we're looking good. So basically, what I just said through the stream is that revenues are looking solid. Net profits are completely wonky. Cash balance is concerning. This is like almost like a death drop. Reason it's a death drop is just because you've seen a lot of companies. If you analyze a lot of companies, you'll see that the cash balance, when it starts to decrease like this means that they're diving deep into their pockets to try to field their the interest expenses that yield from their obligations, their liabilities. So that's really concerning. These net profits and cash balance are two strikes, at least in my books. And then the balance sheet, as you guys have been through the live stream, you definitely understand. Total assets, stockholders' equity, we want to see anywhere north of 50% for this figure, and it is not for Cisco. It's not. So book value per share is $8.91, which is just a sweetheart ratio that we all know and love. But one thing I do want to repeat, let me see if we're good to go. Yeah, no problem, Caesar, no problem. And thank you guys for letting me know. So let's see. One thing that I was talking about before unfortunately we went on mute, if you look at the oldest companies in existence, Japanese companies in particular there's a lot of Japanese companies that are they're known to be quite mature. There's some. Let me preface this by saying that there's some financial gurus who will say that, well, typically you want to see with a mature company, you want to see them actually use their credit, leverage their credit, and put liabilities on their balance sheet to continue to expand, right? But the oldest company in existence, at least from memory, is 1,400 years old that comes out of Japan. And the reason they went under, unfortunately, they got bought out and then eventually dissolved, is because of debt. So they were 1,400 years old. Imagine a company like Cisco. I just don't think that that's appropriate. And if we're going to be putting money in a company like Cisco, then we want to see this value be a little bit higher. And then lastly, cash flows is what I just left off with before we hit their intrinsic value. So we're looking at 15 billion and some change in cash flows from operations, total assets amounting to 94 billion and some change. Cash flows from operations with respect to assets amount to 16%, which is solid. Typically, we want to see anywhere north of 5% for this. Quality of earnings ratio, you guys have been with me. You know and understand that this is an accounting fraud measure to make sure that the net profits that they report are not inflated. So cash flows from operations in the numerator, net income in the denominator. We want to see this north of 1, and they're at 1.38, which is solid. Now, their intrinsic value, $11.45 per share to $42.22 per share. And $11.45, if you're new here, welcome to the channel, by the way. $11.45 is that this represents their cash and cash equivalents. So for every share issued and outstanding, they have a 10-year median cash balance of $11.45. Now I build in that 10-year median because I don't want to fall prey or fall victim to selection bias. So we definitely have to use a bit of descriptive statistics to create this figure, but this is definitely a rational, reasonable figure to use for the low end, because if you were to buy the company at $11.45 per share, then basically you'd be getting the company for free. Think about it. Cisco is given to you. You give the guy $11.45 per share, which in this case it would be, I love doing this math. So we take $11.45 per share times there. Let me move the Cisco guy out of the way. Yes, let's accept this correction. Let's move this guy out. So this is going to be $11.45 times 4,254, right? But then we have to multiply by 1 million. And let's see what we got. So look at that. That's massive. So if you were to give some random guy 48, geez, let's see, this is millions, billions, 48 billion and some change for the full company using the ownership, the owner-centric perspective, then you begin the company for free, because you go on Monday, you open up Cisco's doors, and the first thing you see is their cash vault, cash and cash equivalents, and guess what? They have the same amount that you just paid for the company. So this is why we use it on the low end. On the high end of things, this represents the company's earnings. So for $42.22 per share represents the company's earnings based on this is all based on off of its performance, its business performance, but there's a multiplier in here of 20. 20 represents the maximum time horizon that we should be willing to wait to get our earnings back from the company using our owner-centric perspective. Let's do this math one more time because I just want, before we look at the share price, I want to make sure that we know exactly where we stand with Cisco. And let's see what that yields, and then we will multiply this number times 1 million. And that's huge. Let's convert this to dollars. Okay, so $179 billion and some change, if you're using the owner-centric perspective, is how much you should pay for Cisco on the high end of things if you're basically going to pay for 20 years of Cisco's earnings. So you're only going to go into the black, right? You'd be in the red for 20 years. You're only going to go into the black 20 years from now. Now, who knows what's going to happen in 20 years? Nobody knows. So this is why it's the high end, but even 20 years, even this high end, it's kind of concerning. This is based off of Cisco's actual numbers, so let's push forward and see what Cisco is trading at right now. What did they close at? And it looks like Cisco closed at $44.77 today, which was January 22nd, which means that they are just $2 overvalued. So very similar to Intel in the sense that they are slightly overvalued, but not by much. So this is very curious to me. Definitely, if you are considering an investment in Cisco, I would look for an explanation for 2018's net profit. I think this is the largest value violation from a value investing perspective. You know, the fact that they got so close to not turning a profit in 2018. It's like the biggest mortal sin that any publicly traded company can do, not turn a profit. So 2018, I definitely look for an explanation for that. And then I'd also like to see an explanation for what do they plan on doing for their dwindling cash balance? And really, why is the cash balance decreasing? I mean, we postulated that it's most likely due to the fact that they can't meet their obligations, right? They can't field their interest expenses from the liabilities that they have that are on their balance sheet. But we would really need to find out, those two things. Revenue seems fine. So let's see if we have any requests in the chat. Let me just say thank you to all the friends in the chat here. Thank you guys for letting me know. Definitely going to have to fix that. Thank you, NYCFC. I appreciate you letting me know. Yeah, I think what happens is whenever I come off of OBC, which is the system I use to live stream, I guess it just goes out. So we'll have to look into that for sure. Okay, so let's push forward. Let's do one more analysis. Let's see. Alibaba. This is an interesting one. Let's see what we got going on here. Let me pull some things up for Alibaba. Let's get rid of Yahoo, DJI, this guy. Alibaba is a curious one for sure. Let's go to Google. Okay. Okay, so sound should be good now. Not sure why that keeps happening, but that'll definitely be fixed before next Fundamental Fridays. We're going to be doing Alibaba now, and I just wanted to take a look at what Wikipedia has to say, switching it up a bit and moving from the SEC stuff, since it's the last company that we'll be reviewing for Fundamental Fridays tonight. I hope you guys have had fun so far. I just want to take a look at when they were founded. So in 1999, they've had 21 years of progress. And they are a Chinese multinational technology company. And if you guys know anything about them, They actually, Jack Ma, which is their founder, had to go into hiding for basically criticizing the Chinese government. And he just came out now after, I think it was a 2-month hiatus. Incredibly fascinating, curious case, and kind of sad too, because Alibaba is really the engine, the sourcing engine for Amazon's progress. So the fact that Jack Ma is kind of going through some trouble with the Chinese government is a bit concerning. If we're considering an investment, a value investment in Alibaba, in doing our fundamental analysis, that's something major, really huge that we have to consider. The fact that they're not in America, for all the troubles that America's had. I mean, the fact that China is doing this to Jack Ma, he had a company recently that he tried to take public, an IPO, and they shut him down as basically as a punishment for talking against the Chinese government. Nothing against the Chinese government, but it's just sad to see what's happening with Jack Ma and how he had to go into hiding and all this nonsense. So let's push forward into the analysis of Alibaba. Their revenue is looking solid. I mean, this almost looks like a geometric push in the upward direction, which is intense. And really, this is quite an aggressive revenue trend in the upward direction. Let's take a look at their net profits and see if net profits mimics the curve, and in fact, it does. These gyrations, right? This variance is, I guess, it's to be expected when you have such an aggressive increase in revenue over 10 years. So net profits are looking solid as well, and I would say that they definitely mimic the revenue for sure. Maybe they're not as dramatic in shape, right? The curve itself for the net profits is not as dramatic, just slightly depressed here towards the end, but we're looking solid. Cash balance for Alibaba is looking strong as well. So cash balance is mimicking both the net profits and the revenue, which, I mean, when these three sheets agree with one another, that's a huge sign, right? That's excellent. Yeah, I mean, cash balance is really nothing to be said. There's no strange or dramatic dips like how we had with Cisco. So we'll take a look at their balance sheet and see what they got going on. Now, Alibaba held total assets in the amount of $185 billion and some change. Stockholders' equity was at $122 billion and some change, for a total percent of assets owned in the amount of 66%, which is massive, massive. This is really great to see. They're passing this test with flying colors. Book value per share is at $46.08, so keep that in mind when we push forward and look at their actual share price. Now, cash flows from operations are $25,507 million. As compared to their total assets, it's 14%, right? So cash flows from operations represents 14% of their total assets. Remember, we want to see anywhere north of 5% for this figure, and the quality of earnings ratio, which checks for accounting fraud, is at 1.21. Remember, we want to see this number anywhere north of 1. So Alibaba is just looking incredibly strong. Before we push forward to the intrinsic value, let me just click in Alibaba here and see if they have Alibaba listed in ready ratios. Looks like they don't. Alibaba, no, they don't. Let's pull up Alibaba. We'll do it backwards as a way to end off. So Alibaba is currently trading at $258.62 with a PE ratio of $34.40. So it's kind of inflated, at least the PE ratio. And I typically don't like looking at technical signals, technical analysis signals, but for this one, we'll definitely take the help. I can already tell that it might not yield the best results, but we'll look at the intrinsic value, and it's ranged from $6.80 to $29.21 per share. So it's a bit disappointing to see that Alibaba will post these excellent numbers and then be trading so highly. And I mean, you can understand the market hype. They have very strong numbers, and I think the market's responding to that. But you have to keep in mind as well, they're in an economic framework that is not, it's not American. It's not an American economic framework. The Chinese government, in particular, is, in my opinion, harassing Jack Ma for some of his recent expressions in critique of the Chinese government. I mean, they retaliated against him when he tried to launch that IPO, so he's not really in good favor with the Chinese government, which of course houses Alibaba Group. So $6.80 to $29.21. Of course, we know by this point in the live stream, $6.80 represents the company's cash. So for every share issued and outstanding, Alibaba has $6.80 in cash and cash equivalents. On the high end, $29.21 is what we should be willing to pay. Keep in mind it's a 20 times multiplier of their earnings. So it's what we should be willing to pay for an investment in Alibaba Group. Now, to end off the night, we'll take their shares outstanding, and let's just multiply this times this number here times 1 million. And then this represents this number here. Let me push it over so it's not misleading. Right there, beautiful. So this number represents the price tag. So this would be the price tag for the entire company. It'd be $77 billion and some change. What's their market capitalization right now? So their market cap is basically $700 billion, which is massive. So I know these numbers are huge, and as investors, you know, at least most of us, we don't have access to this kind of capital or this kind of leverage. I know I certainly don't, and there's no shame in it. We're at different levels, but you know, if you think about this reasonably here, you remove the immensity of the numbers and you just look at the market cap of $700 billion, and then you take a look at our calculation, which is based off the company's earnings, right? And you realize that you should only be willing to pay for $77 billion because the net earnings of this company, this is the maximum that the net earnings justify for Alibaba Group. There really is no justification for $600, $700 billion price tag for Alibaba. I mean, what are we really paying for when we're paying $600, $700 billion for Alibaba? Now, I understand that, you know, we're not paying that amount, but proportionally speaking, we are paying that amount, right? The $600 billion when we buy shares in Alibaba that are worth 200 and whatever dollars that they traded at today. So it's definitely good to keep in mind the owner-centric perspective. Let me write that out. The owner-centric perspective. So we definitely have to keep this in mind, right? When we're fielding investments in these different companies, it's incredibly important to remember that we shouldn't be willing to pay 6-7 times our figure, which already has a 20 times multiplier. I mean, if you consider the fact that 600 billion, let's see, 600 billion million thousand, right? So how long will we have to wait to get back our earnings, to get back our investment in representative earnings with this? So in this case, this has a 20 times multiplier. Let's take this and divide it by 20. Remember, 20 is the amount of years that we'd have to wait. So then we can simply take this number and divide it by this, and then working backwards, this is not a dollar amount, but this is a year amount, actually. So years to wait, right? So we would have to wait 154 years for Alibaba to generate earnings, at least based off of the company's last 10 years of earnings. We would have to wait 154 years to get back our investment in representative earnings. Now, I understand that they're going on the uptrend, so this would most likely be cut in half, and according to the power law, you know, principles of power law and just general increase like inflation, what have you. I understand that, but still, working from this number and trying to engineer it backwards to come up with a more reasonable figure, I mean, this is huge. Compared to Intel and compared to Cisco, which are the companies that we reviewed today, I'm definitely not so interested in Alibaba, just considering the fact that they are so overpriced. Excuse me. For one, they're overpriced. Jack Ma is currently being basically persecuted by the Chinese government. Yeah, I would definitely look at Intel. Intel is looking much more interesting. Cisco is looking okay, but Intel for sure is definitely the star of the night. Now let me take a look at let's see. Let me take a look at the chat. And we got a question from NYCFC. Is Alibaba an ADR, and does that have any effect? Value investing, fundamental analysis. That is a great question, NYCFC. And I don't have an answer for you with respect to the ADR portion, but I will look into that, and I'm going to write that down now, and I will have an answer for you next Friday. I'm going to look into that. Does ADR have impact? So my initial inclination, NYCFC, is that it doesn't. It doesn't. ADR from if I understand ADR correctly, and I don't have a proper understanding of what ADR, but in my opinion, at least from looking at all these different companies, there's a lot of companies that will identify themselves, or at least identify the listing on their NASDAQ stock name as an ADR. And well, the numbers really speak for themselves, not so much how they title it. But of course, I could be missing something completely, so I'll do a bit more research for you, and I'll have an answer, no problem. That is I've actually had that question myself, so I'm happy you asked it. Beautiful. And then, as a matter of fact, NYCFC, you brought up another good point, which was on goodwill, and I want to touch more on that next Friday. So I'm going to be writing that down as well. I want to touch on goodwill, and I'm gonna look to see if maybe Warren Buffett, Charlie Munger, or even Benjamin Graham, if they have any tidbits on knowledge with respect to goodwill. I want to clarify that point a bit more, because there is something to be had with goodwill. I mean, goodwill is basically the brand power, right? The amount of recognition that the company receives, and the strength, the loyalty of their customer base, which I guess you could try to enumerate, but from all the research that I've done, it really does seem like a crapshoot. I mean, the company just names their price, puts that as goodwill, and so be it. Keep in mind that the companies, right, private equity companies, or private companies in general, when they first are founded, they don't have goodwill listed on their balance sheets. As a matter of fact, the goodwill item that's listed underneath assets, long-term assets, that's only generated by companies that acquire other companies. So for example, if Alibaba were to acquire, let's say, Brenden International, and I had a really strong goodwill that I say, hey, you guys got to pay $100 million for my goodwill. Well, if Alibaba was just a normal, regular company with no acquisition history prior, their balance sheet before my acquisition would not have goodwill on it. But the moment they acquire me, then they would list goodwill on their balance sheet, which is very fascinating to me, because it's kind of breaking the some of the principles of accounting, right? Because why should that original company have their brand value listed on their balance sheet as well if it's something that's transferable to an acquiring entity? So very curious. I'll look into goodwill, see if Warren Buffett or somebody has something to say about it, and then I'll also look into ADR for sure. I appreciate you guys for stopping by and sticking through with me for the full time. It's currently 8 p.m. in New York, so I will be seeing you guys later. Make sure to subscribe to my channel if you haven't, so you can continue to gain insight on how to analyze investment performance, how to analyze companies, so that way your investment performance is optimized. Remember, when it's optimized, and your wealth production is optimized as well. Have a great rest of your night, guys. Take care, stay safe, and I'll see you guys next Friday for the next fundamental analysis. Yeah, no problem, NYCFC. Have a great one, guys. Be safe. Bye.